Welcome back. Big is not always the driving factor, so what is the mark of a model merger, acquisition, or a joint venture? Let's go to Matt Simmons.
Well, first of all, I don't think size has anything to do with quality. You know, I'm biased because Simmons and Company is a very small investment banking firm compared to the mega firms we compete with that don't add any value. I think we do. Honda Oil Company, privately owned company, they're probably the most efficient oil company in the world, and they have a model that used to be people are our most important asset. They've now changed it to culture as their most important asset. So I think that that's the critical mass issue, is do you have a culture that is so enjoyable that it stimulates creativity, so therefore you have the best people, and the best people will figure out a way out of a mess twice as fast as average to mediocre people.
So we've talked about these vital factors, the culture, the technology, the assets. So which is the most important consideration in this merger, acquisition, or joint venture? John Gibson, tell us.
People. If you're able to put the two groups together and maintain enthusiasm, motivation, and focus on the vision of the company, you'll be successful. You can take good people and a bad idea and have a success, but a good idea and bad people, it results in failure. So people, and then that long-term vision.
Well, yeah, you say that, but the first thing out of the chute is we lay off. You know, the first thing we do when we merge, we lay off, you know, how many tens of thousands of employees or some number of employees for the benefit of getting us down to a good value proposition. So the motivation aspects are immediately challenged. So your people are down when you want them at the most opportune time to be moving forward.
David, culture, technology, asset.
The people side of the equation is really hard. I worked with an organization that merged, and 2 years after the merger, sitting on one floor, they still had the groups from the separate companies sitting separately on the floor and not communicating together, not working together, not doing any of the things that you need to do to really drive value out of it. And so I think people too easily get focused on how do I combine these systems and how do I combine these fields, and they get rid of a bunch of people when they're not really focused on how do I make this exciting for the people. How do I build a culture within this new organization that brings it to life for folks so that they can really get behind the vision that the executives have for the merger in the first place?
I think that's going to be one of the biggest challenges for CEOs in mergers and consolidation, which I agree are inevitable, is how do you actually get one culture out of 3 or 4 cultures? Because if you're not able to, you're never able to really take advantage of the best practices. You're never ever able to take advantage of the really great pieces from each of the different companies and dispose of the bad ones.
That's right.
Now, is that a problem that comes because we still have ExxonMobil and the names all kind of linked, so we don't have we still have our own company within a company?
I think it makes it hard. I mean, I like the Total Elfina consolidation to just Total or Chevron. I was a Gulf person, so I guess it should be Chevron Texaco Gulf. But honestly, it's Chevron, and Chevron has a great culture, and they should really take that core culture, and if you're the acquirer, I think you have to bring the cultures together to be one.
Well, we know that in the oil and gas business, companies are judged on the value of their reserves. Now, when companies combine, what are some of the issues that need to be evaluated? John Olsen.
Oh, I think that would require an answer that might take all afternoon.
Well, we don't have that much time, so.
I think that just to begin with, though, and to summarize, clearly the asset quality, clearly the people quality, the oil and gas reserves, to render them as transparent as possible. Coming from Wall Street as I do, I am amused to see that most analysts and portfolio managers and the like never have any access to the reserve reports. For instance, you get a summary or a footnote in the annual report, that kind of thing, but you never see just how the decline curves look overall for the company. And I suspect that if analysts were to see a lot of this data, that they would have a lot of second thoughts about the valuations they put on some of these companies.
Matt, what are some of the best practices and maybe some of the worst practices for handling the reporting and auditing of reserves in your view?
The best practices would be to actually have a sanity check and say, why don't we audit them? The worst practices are to say, we don't need to do that because we know more than the auditors would know, and so we're going to give you a ballpark guess of what we would hope our reserves might be, because the higher the number, the lower our per barrel costs are, and so I can lie better than my neighbor. Excuse me, I can estimate better than my neighbor.
Well, that's interesting. David Johnson, what do you think?
I think every time you go through a merger or acquisition or something like that, you have to focus on the reserves, kind of take a fresh look at it. I think it is critical to have the outside reservoir engineers come in and give their assessments. Too many times I've seen organizations sit here and say, we're only going to rely on our internal engineers and their assessments. But you need to have that outside independent look, if for no other reason than to evaluate how well your own engineers are doing.
Tom Fry, let's hear from you on best practices.
Well, I concur with the last comment. I think one of the most important things companies can do, not only in the merger and acquisition area, but just from the standpoint of managing their own business every day, is to have outsiders who have no vested interest in the outcome of a reserve study, independent, look at those reserves to determine whether or not they are accurately reported. We all know it's a best guess, but the best guess done by really smart people and really motivated people to come up with the right number is much better for the company and for the investor.
Okay, we have some very big service companies to handle big clients, and John Gibson, what are some of those key drivers that are pulling these companies together?
I guess I catch this question because of my experience with Halliburton.
Of course, yes.
It really is the complete solution that a lot of the customers are looking for because of their procurement practices. We find that procurement is one of the major emphases in companies today. They want simplification of that. They want to get as much as they can around high-value components in a single source solution, particularly in difficult-to-reach areas. If you're working in Gabon or Equatorial Guinea, it's very difficult for you to manage the logistics of bringing in 8, 10, 15 different suppliers.
I think that the one great advantage you have when you do go into one of these major companies is the integration of all of the information that's available to you with people that know what's going on. So when you've got research areas going on here or somebody trying to estimate reserves over here, you better have some group of people that are communicating pretty well together, because I'm going to be writing down a number on a financial perspective, but I need to trust the guy, the engineer, that's provided the assumptions.
Maybe what we need is a Surgeon General sort of remark on reserve for companies, and that is that the reserves that are presented may or may not be accurate to a 10x. But joking aside, I think one of the things that we do when we buy shares from the stock markets, we buy them from companies we know have integrity. When you buy an ExxonMobil reserve, you know their processes, you know their people, you know their culture. You have a lot of confidence in their reserve estimation because of the company. I think the market itself will vote and put multiples on companies based upon the integrity, the culture, and the people, and the processes as they become aware of them and do due diligence.
And I think that's one of the reasons why companies react so quickly when they see a problem in an organization, because they are basically saying, I can't look at all of that activity. I'm relying on their integrity. And the second they have a problem, it just extrapolates in the market wildly because of people's reliance on the company's integrity.